Contrarian. Wake up, motherfucker.
Yo, March 31st, 2026. Eric says, "Where's the pump?" The pump is there. What are you looking at? I don't know what kind of pump you're expecting, but we already got the pump. All right, let's see what we got here. So, what did I tell you to buy? WebL, AIBU. I guess if you were doing GDXU, that's also up 15% or some shit. I don't know. Whatever. Blah, 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 blah. All right, let's see. Okay. IGV, the most hated ETF since when? What the fuck was this? October? All right. So looks like we're going to get a recovery here. So let's see. Friday was low. We got some little movement on Monday before pulling back. And then Tuesday, we're going direct correlation between IGV and the other ETFs. No, the problem is there's no such thing as an IGV thing. You got to be patient. The problem with gold is that it's doing its own thing right now. That's the problem. You see this? You're going sideways, honestly. You're going up, you go down. You go up, you're just gonna stay flat. This is why I told you patience. And then what did you say yesterday? You were saying like, I don't know what Trump is gonna do to make the market go up. Patience. If you just want to follow day to day, then just do day trading. Then honestly, day trading is a whole nother animal. I don't do that shit. I just do everything that like has the most bang for your buck while you don't have to worry about day trading. Noise that moves things, therefore that's why. Yeah, you said oil use suck too, right? And then it's up 100% after 2 months. Right? It's all about patience. Yeah, WebL will eventually go up. Sadly, because there is no direct leverage ETF for IGV. You basically have to do what you can. The only thing close enough is AIBU, which is only 2x, not 3x, sadly. And then WebL is 3x, but that mostly follows the FDN. You see the FDN here? I want something that follows the IGV. If you had something that follows the IGV, you get a better performance, but there's no such thing. There's no ETF leverage that does it for you. The only thing you could possibly do is if you do AIBU plus WebL, then you have to add in individual stock ETFs like CrowdStrike. CrowdStrike yesterday was up 4%. If you use this 2x ETF CRWL, you can get 10. But then now you're taking more risk because you're being influenced by individual stocks. You could also do like Palantir, right? Palantir was down, negative 12% with the 2x ETF. So it was down 6%. This is down 12%. You could have bought that yesterday, but that's more risk. So everything you do, there's a trade-off. There's no free lunch. You want higher bang for your buck, you're going to take more risk. More and more risk will be added to the thing. I don't do that shit. So I basically do things that have the best probability that I'll be successful, not based on, what if this thing went up 20% tomorrow? I don't do that. I'll do something maybe 10, 20% over 2 months, sure. If I see something yesterday I did short semiconductors again because it was a good day trade, because the setup for the day trade makes a lot of sense. So let's look at here. Let's look at this. Okay. So if you look at the ETF for SOXX semiconductor, you see it tried to open up here, but within 10 minutes it went down here. That's when I started shorting again. I was already shorting it here into Thursday. Then I did a little bit more short. I left a little bit for Friday and I sold everything out. And then on Monday, when I saw it go up here and then it immediately went down back to the lows of Friday, then that's a good short. Okay. So if you look at the 15-minute short chart here, Yeah, you could day trade it. It's easy because you have a trend on the 15-minute. The 15-minute, you see the trend here, 18 and 40, and then it bounces up into that downtrending moving average, and then it goes back down. So if you look at like a 3-minute, okay, it's doing this. You would open a short here and then say like, okay, I'll give up if it goes back up here, I guess. You know, you could set a stop up here. So you kind of have to do that. And then you just let it go down for the rest of the day. Hopefully it goes down for the rest of the day. That's what I had to do because it wasn't finished within an hour, right? You see it? It just goes down, goes up, goes down, goes up, goes down, goes up until finally the day it ended at the bottom. So then I switched over to SOXL. I did not care about going into XOXL because semiconductors, in my opinion, are still already very high. So if I'm doing SOXL, I'm just assuming like, hey, yo, this is already way too low. It's going to bounce, which is today, and I'm just going to get out again. So I already might as well risk it going back up just in case, and then I'll just get out again. So I just get out again, right? This is like, okay, you go down 7%, go up 7%, get out. That's it. Very quick. But to me, I don't like those type of things. I'd rather you have something that will last a week, at least, or at least a few days. Who knows what it goes on to this? That's why I recommended AIBU and WebL, because I think it'll go up until Good Friday, right? So Good Friday, the market is closed, so it'll go up until Thursday at least. I don't think they're gonna do anything, land any troops this week, honestly. So yeah, this thing has more to move up. So if we look at like IGV, that's the problem. There's no ETF that tracks IGV. If there was, there's a better chance that you'll make a lot of money, but there is none so far because here you can go up here. So the best I can do is say like, well, you buy a little bit of WebL plus AIBU. And then if you want to do single stocks, you could do CrowdStrike and Palo Alto Networks. So look, you got 11%, that'll be 30% overall. Okay, if it comes back up here, just in case it does that. So yeah, there are other ETFs out there. So PALU, Palantir, not Palantir, Palo Alto Networks 2X. I guess you could add that. You could add CrowdStrike, CRWL. You could add that. You can also add Palantir, right? PLTU. I don't know. You can add all those things, add them together, and make your money that way. That's how you would do it. Yeah. As far as gold, the problem is there's no more taco trade with gold. Gold is doing its own thing for its own reasons. Basically, it's just following Japanese bond yields versus U.S. bond yields. So that's something you have to consider doing this. That's a little bit hard to understand because a lot of you guys don't know shit about bonds. So it's kind of hard for me to tell you those things. And a lot of the movement happens overnight too with gold and silver. Everything during the day does not happen. Right? Very rarely. So if you can't trade overnight, you're taking a lot of risk too. Because you can't take profit overnight if you don't have access to overnight. So that's pretty much the thing here. What else we got? Yeah, the other thing too is 3-month versus 10-year yield. 2-year yield. So you can see it's kind of recovering now. The other thing too, this is just the treasury market versus each other. This is the yield curve. So that also will affect things. No. I don't think the GDXD to GDXU thing worked. It worked last week. It's not going to work this week. That's my bet. That's why I say avoid it, because I don't think you guys have the knowledge to understand how it moves. You guys, you go bet for it if you want, but I bet it doesn't work. I bet GDXU still goes up or flat. That's what I'm saying. I don't think you guys think it's like everything is just 1-to-1. Like, ooh, Trump says this will move like this. Maybe sometimes it does, sometimes it doesn't. but you guys don't have the knowledge of bond markets or currency markets to fully understand how gold and silver moves. That's why everybody in gold and silver are retarded. They don't understand jack shit. The dollar, Japanese bonds, UK bonds, German bonds. They don't know shit. So don't trade it if you don't understand what you're doing. That's my recommendation. You can look at the charts if you want. To me, honestly, if I just look at it from a technical standpoint, I would say like this thing is trying to get back into this pink zone. Okay. Maybe if it gets GDX gets to 91, maybe you can short with GDXD. I don't know. Or maybe it'll just punch right through and go straight up to 101 before shorting. Yep, there you go. Other thing pisses me off, AIBU chart barely updates. That's because it's low volume. Not a lot of people know about this ETF. This ETF is brand new. That's why it doesn't update, because it has low volume. That's why. Sorry. The best thing you could do is just follow IGV, FDN, SKYY. That's it. It kind of follows sort of those three things. That's all you can do. That's why UwU updates less frequently than Gush, because people actually use Gush more than UwU. So that's why. So yeah, that's why nobody uses it. Very few people use it. You'll be the first guys to use it, I suppose. But honestly, overall, they follow the QQQ, okay? NASDAQ. If NASDAQ goes up, those things will go up. So that's how it works. Anyhow, yes, SOXX, where will we go? We probably will get to 323. I'll probably short again the SOXS or something from there. This is the other reason, like Tropes asked me, do you follow SOXL, SOXS? No, because to me, overall, it doesn't matter what Trump does now. I think semiconductors is eventually going to pierce this purple line at 311 and start crashing down, because it's all about earnings overall. Taco no longer affects it. So Taco will have very little influence on semiconductors. Taco will have very few influences on gold itself, I think, from now on. It's all about the Japanese with gold and the Chinese with silver. And it's all about like earnings results with semiconductors. The next earnings for semiconductors is TSMC mid-April, so around tax time. So people are just waiting for the next set of earnings. Micron did not impress, and now people are getting punished for it. If you look at Micron, you see it's getting punished. So I showed you guys this. Doesn't matter what Trump says about Iran. If people didn't buy Micron after earnings, because you look at this huge volume here. It went down, right, after earnings. There was some people trying to push it back up, but as you can see, it went back down again anyway, because the next day it went back down to the low of the previous day. So you had earnings after hours. You had somebody fighting over here. So you decide, okay, there's a lot of volume. Are they buyers or are they sellers? It looks like 1-2 days after it just went down. Now, was it because of options expiration? Could be, but then the next week, down more, down more, down more. So, I mean, you got no options expiration anymore. You got no influence on earnings anymore. And this stock keeps going down, 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 down for 2 whole weeks now. Now we have another input of volume here. Okay, let me zoom out to the daily. What do you see now? So there's a lot of volume yesterday, right here. Okay, if we look at the Wyckoff chart, you see how good it matches distribution. So as we go into April Fools, we will have a new set of options for the Morgan, JP Morgan collar. Okay. So people are waiting for that. Will the market puke or will it just recover a little bit? If this thing recovers, let's see how far it goes into this bar. If it just goes, oh, it's trying to get most of it bar, and then it just goes back down, then that's it. Then we're done. We're going lower. We're going back to 230 on Micron. That's going to put a lot of pressure on the other memory stocks because yesterday you saw it. SanDisk went down. Okay. Western Digital went down. What else? Seagate went down. And then you saw the optical guys. Lumentum went down. Okay. Ciena went down. Coherent went down. AOI went down. So a lot of these all-star stocks last quarter no longer are going down. You don't think gold crashes? I don't know. Because Friday it didn't happen. Friday, you had Trump do anti-taco stuff. You had Monday morning, we had Trump do anti-taco stuff. He started threatening more things on Iran, but nobody listened. Nobody cared in the gold market. The NASDAQ went down, but you look at gold, it still was trying to stay up. So that tells me, why would gold care if Trump puts troops on the ground? Why would gold go back down again? If gold is ignoring Trump now, it's going to ignore Trump even more later on because it's following the yen. If we are going to have higher energy costs for longer and the Japanese yields start going up because nobody wants Japanese bonds, they don't want Japanese yen, then gold is just going to keep going up again. That's it. It no longer follows the taco trade. It followed the taco trade fine up until last week, but it no longer follows. You see, it's a dynamic system. This is a dynamic system. It's not a static system. People always think like gold goes up, stocks go down, or bonds go up, bonds go down. There are many times when bonds go up with stocks, which is what we had in the 90s and 2000s, up into 2010s. There are many times when gold follows stocks and doesn't follow stocks. It depends on the regime you're in. Okay? Are you at a liquid state? Are you a gaseous state? Are you a plasma state? Are you a solid state? This is why people can't do trading, because people think it always works one way. If it was so easy, everybody would be billionaires, but they're not, because it's a dynamic system. It depends on the state of the system. The state could be in any state it wants to be. There are sometimes gold will act like this way, and sometimes gold will act like another way. And that's why I told you guys to listen to Samantha LeDuc. Samantha LeDuc really understands this very well. I think out of all the people I've listened to, she really understands it. So if you have a lot of money, I think it's better off. You're better off listening to Samantha than me. She does it a lot better than I can. So, and that's what she does all over years. Anyhow, what the heck is PL? PL is that space stock or something? Planet Labs. Okay, yeah. Well, yeah. This is a hype stock, a meme stock. Yeah. Okay. Hmm. Yeah, I think I talked about this a few times. $3 was the where you broke out. So April was a good time to buy, huh? Because it went above the $3. It went back. It followed the market, and then after that, it just went zoom on its own time. Although it's very volatile, it still has a trend on the weekly, I guess. I don't see anything particularly wrong with this stock, but it's purely running on momentum. So you're just going to have to assume that these types of stocks do not care about interest rates. If they do care about interest rates, this will eventually fail. I guess if it drops below $23, that's or 20 to $23, I guess that's a signal it'll fail. I don't know. Yeah. I mean, if you have it 500%, there's no reason to sell it. Anybody new and they're looking at this and they're like, "Oh, it's easy. Just buy it back when it touches the purple line, right? It touches the purple line, buy. Touches the purple line, buy. Touches." But if you bought way back here, I don't think you would care. You could just keep holding it. I don't see any problem. Have to place. Well, yeah. I mean, her vids are just free though. Like most of the stuff she keeps behind a paywall, right? You got to pay her money. This is not free stuff. You know. If it has momentum, yeah, just keep going. I mean, that's the thing, right? It just has momentum. Once you have momentum, it's gonna keep going. Like there's no reason not to. I know Martin Shkreli hates these types of stocks. Martin Shkreli looks at this thing and he's like, and I gotta short it. But it still hasn't crashed yet. So that's what happens when you listen to fundamental guys. If you listen to fundamental people, they look at this kind of company, they go like, there's no reason anybody should buy this company. The same thing with Palantir. Why would anybody buy Palantir? Palantir was expensive at $20. Palantir is expensive at $200. Palantir is still expensive at $142. It has nothing to do with fundamentals. It just depends on how many people want to buy it, how many people want to sell it. And it depends on the price that they are willing to buy and sell. Okay? So anyhow, this is just gonna be a short stream. I'm not changing what I'm talking about since Sunday night. I told you there's gonna be a pump. There's a pump. The question is like, oh, do you want to do gold? Do you want to do SOXL? To me, it's a bit more tricky because semiconductors, the way it moves is based on earnings more than taco right now. You see that? Like Monday, it finally puked because I think we're coming into the end of the quarter and people are like, well, I got to rebalance my portfolio. Every quarter, they got to rebalance their portfolio. Just like Friday, you had all this people running into oil companies. It's like, why? Why are you buying oil companies at such an expensive price and getting out of software companies at such a cheap price? You know, it's because like they're rebalancing. Like you think people just completely sell a stock and buy another stock? No, they're just changing the percentage of exposure. So if I'm a very, very rich guy, I have like billions and trillions of dollars. I'm just selling a little bit I'm trimming, right? I'm just changing the percentage. Like maybe I have 15% oil stocks, 40% tech stocks. I'm changing 40% to like maybe 35% and changing the 15 to 20% in oil stocks. But a very rich guy doing that affects the market. Okay? And if they're like, shit, I made a mistake. I allocated this thing incorrectly for quarter one. I'm going into quarter two. I'm changing it. Changing 5% on a rich guy's portfolio looks like a huge change in the price on Friday, right? And then again on Monday with semiconductors. It's just like, but it's noise. It doesn't mean shit. So that's kind of the problem, you know? It's like you guys don't know what the reality really is because you don't know who's the big guy, who's the small guy, why is the price moving the way it is. And companies like PL, Planet Labs, is just another reason to like be like, oh, well, it's just moving because it's a small stock and it's easy to manipulate or what? I don't know. Or is it because like a rich guy is just allocating 1% to Planet Labs and now he's allocating 2% to Planet Labs and you just see it keep going up every goddamn month, right? Because he's just buying and buying every month incrementally. I have no clue. I don't have that information. So I don't know. I just look at a chart, dude. That's all I have. So if you look at the damn thumbnail I made, so it's like this. Everybody was bearish on Friday. Everybody was bearish. And it's like, oh man, you're going to pump, dude, because if everybody starts agreeing with me, you're pushing the boat on the other side. And it's really easy to flip the other way. Okay? That's just really how it is because every market needs a buyer and it needs a seller. If you're going to have an agreement on price, you need to have an opposite counterparty. If I'm going to go lower in the S&P 500, I need someone to agree that the S&P 500 is no longer what? $4,000 a freaking whatever. I don't. It's not a share, huh? Because it's an index. There's no shares here. So let's see. SPY, right? It was down 600. So if I think the S&P 500 is going to go down to 5,000 or 4,000, I need someone to agree with me on the SPY that someone will buy my shares at 400, 500. And the thing is everybody agrees and nobody's on the other side of the boat to set the price. A market needs two guys, a buyer and a seller. If nobody is on the other side of the boat, then how can the market crash any further? You need someone who thinks like the market is going to go down even lower, but everybody's already agreeing with that. Nobody out here on this side is willing to buy it at that level if everybody already agrees it's at that level and they already are in the market. They already have those shares. So yeah, that's why it's not going to happen. I mean, this is a simplistic way of thinking about it, but I think for most people, that's okay to think about it like that. Of course, we already talked about options and things. The market is not that simple. Okay, but you can think of it like that. When everybody agrees with you, therefore it's not going to work anymore. Okay, I think for anybody that doesn't want to understand the complexity of the modern stock market, that's a fine way of looking at it. So if you see everything on the news agrees with you, if you see everybody on Twitter agreeing with you, then I'm not gonna fucking do that trade anymore. That's why oil is like, fuck that. Everybody agrees with me now. Oh, everybody wants to short the market now? Fuck that. I'm not gonna agree with you anymore. So I'm gonna allow it to bounce, get it to where it needs to go, and then I'll short it again some other time. That's it. That's how you should think of things. Very simple. Because like at the beginning of the year, I drew these lines, right? It was kind of a joke, but not really, because I did believe that we were going to go down this year, and it's following that line. But I drew this line in January. In January, people still had hopes that the market was going to go higher. Now everybody agrees with me that the market's going lower, then it's not going to do that. We're going to have to bounce. See, that's why I drew this new line on Sunday night. It's going to bounce, trick everyone. They think it's going to recover. Then we go back down. And then this is the real drop. And that's where you got to short again. So that's what you got to do. Okay, you got it? I think you got it. Okay, 30 minutes. Okay, I'm just going to do 15 more minutes. I'm going to read these two little articles and then we'll be done. All right, because I think I have to remind everyone what George Soros talked about. This is the George Soros way. And then we'll move from there later. But I'm not changing what I said on Sunday. Everything I said on Sunday will be correct. So let's read a little bit about this. Okay, so blah, 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 blah. I got this little article here, The Psychology of Contrarian Investing, written in December 2013. Behavioral finance. All right. Behavioral finance, broadly defined, has given us a fairly comprehensive understanding of investors' real decision processes. It has taught us to set aside the time-worn fiction of economic man. Okay, what's that? The well-informed, utility-maximizing homunculus with stable preferences and superb computational skills in favor of more realistic models of choice under risk. Investors, we now see, are prone to cognitive errors. This is why I do charts, because I think psychology dominates how people trade or invest. And you, as a free single investor, have more options than the institutional investor. I told you, institutional investing, the people in institutional investing, they're limited in what they can do. They can only buy and sell at certain times, at the beginning or end of a quarter. They have to take in very little cash holdings. That means even if they think the whole stock market is going into a bear market, they are forced to keep staying in the stock market. They are not allowed to have more than 5 to 10% cash. Okay. That's how the banks regulate it, because the banks tell people time in the market and not time timing the market. You remember that, right? A lot of people tell people time in the market is better than trying to time the market. And I'm telling you, wrong. You can time the market. I'm timing the market right now. I told you when to buy oil. I told you when, like, I think the bear market's going to happen at the beginning of the year. So it's like, now you guys are scared of the markets. Then I have to go long because people are dumb. They follow emotions. They don't follow logic. Humans are always humans. So even if we get into the AI world, who is in control of the AI? Humans are still in control of the AI. AI learn from humans. AI learn the bad things from humans. What are humans worst at? They are emotional, illogical people. They are feckless, they are greedy, they are fearful. And as long as that's still true, then the markets will behave in such a way and you go by opposite what they do and you will make money because they are dumb and you rise above the drama. So CNBC can yell and scream and tell you all kinds of stuff, but that's too late. So investors, we now see, are prone to cognitive errors, reluctant to realize losses, and overconfident in their own ability, but fearful that other market participants know something they don't. Moreover, investors seek not only utilitarian rewards, but expressive and emotional benefits as well, such as status and a sense of belonging to a community. Sound familiar? Sound familiar? If you're playing this game just to stroke your ego, you're not going to win. I'm very mechanical in how I do my trading. It's like I see levels, I buy and sell at those levels. I judge probabilities based on levels, where things are going, how the moving average is going. That's all I do. I'm not here to stroke my ego. There's plenty of people that can trade better than me. Okay? I don't give a shit. All I give a shit is like, I have a certain way of looking at things, and I'm just telling you how I look at things. And then from here, that gives you the basic understanding of how to treat markets. And then from there, you can move on to options trading, futures trading. You can find all kinds of people that can do way better things and a lot better technicals or like looking at certain flows. And yeah, Samantha Leduc is probably the next level up. And then from Samantha, you can go even further and move from there. I don't know. It's up to how much you want to study this stuff. A lot of people find this stuff boring. So I think the level that I talk about is very basic. Okay. So thanks to Herbert Simon and Daniel Kahneman. Okay. Richard Thaler, Mir Statman, and many others, we have a general psychology that illuminates the cognitive and affective recesses of investment decision making. So contrarian investors can be situated within the framework of general psychology. There is no need for an abnormal psychology to make sense of their behavior. The contrarian stance is not a symptom of a personality disorder. If some contrarians are antisocial or apathetic, that is because, just like other investors, they are people. Nonetheless, contrarians may reasonably be expected to share some abiding personality traits, such as a spirit of self-reliance, a penchant for critical thinking, and a strong future time orientation. My limited objective in this short piece is to suggest some possible directions for experimental research on the psychology of contrarian investors. C. Thomas Howard provides a useful frame of reference in his important 2014 paper on behavioral portfolio management. His trenchant description of emotional crowds focuses on certain characteristics that may help differentiate the hypothetical attributes of a lifelong contrarian. In Howard's account, the first principle of BPM is that security prices are predominantly set by emotional crowds comprising investors whose purchase and sale decisions are based on heuristic shortcuts, anecdotal evidence, and visceral reactions to unfolding events. Sound familiar? Oh shit! Iran! Oh, sell, sell, sell! Oh shit! Oh goddamn! Micron's going up. Man, RAM prices are going to go up 30 to 50%. Buy, buy, buy. Right? Those are the people you see all over the place. What are you gonna do? You want to be in Micron before Micron does that. You want to be in oil before oil does that, right? So that's the game. Once you see it on the news, it's too late. You got to be there before. You got to situate yourself before the event, not during the event. All right. So let me talk a little bit about Soros so we can end this. Let's see. 37 minutes. Okay. Transcript, General Theory of Reflexivity. Okay, so this was like at a lecture given by George Soros in 2009. In the course of my life, I have developed a conceptual framework which has helped me both to make money as a hedge fund manager and to spend money as a policy-oriented philanthropist. But the framework itself is not about money. It is about the relationship between thinking and reality, a subject that has been extensively studied by philosophers from early on. I started developing my philosophy as a student at the London School of Economics in the late 1950s. I took my final exams 1 year early, and I had a year to fill before I was qualified to receive my degree. I could choose my tutor, and I chose Karl Popper, a Viennese-born philosopher whose book, The Open Society and Its Enemies. I actually have this book on my bookshelf. I haven't read it yet. But yeah, he always keeps referencing this book, and it's on my bookshelf. I haven't read it. So had made a profound impression on me. In his books, Popper argued that the empirical truth cannot be known with absolute certainty. Even scientific laws can't be verified beyond a shadow of a doubt. They can only be falsified by testing. One failed test is enough to falsify, but no amount of conforming instances is sufficient to verify. Scientific laws are hypothetical in character, and their truth remains subject to testing. Ideologies which claim to be in possession of the ultimate truth are making a false claim. Therefore, they can be imposed on society only by force. This applies to communism, fascism, and National Socialism alike. All these ideologies lead to repression. Popper proposed a more attractive form of social organization, an open society in which people are free to hold divergent opinions, and the rule of law allows people with different views and interests to live together in peace. Having lived through both Nazi and communist occupation here in Hungary, I found the idea of an open society immensely attractive. Okay. All right. So now you see like the genesis of where we're going. So, okay, what does this have to do with trading or investing or whatever? Okay, let me go down here. Blah, 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 blah. Okay. Let's see. He's still talking about his past. Oh, man. How does this get me? Okay. It's around somewhere here. Okay, I'll have to go through this. Sorry, guys. You're going to have to get more context. Living with false identity turned out to be an exhilarating experience for me, too. So this is when he got like a Nazi pass, so he didn't he didn't have to get put in a concentration camp or whatever. We were in mortal danger. People perished all around us, but we managed not only to survive, but to help other people. We were on the side of the angels, and we triumphed against overwhelming odds. This made me feel very special. It was high adventure. I had a reliable guide in my father and came through unscathed. What more could a 14-year-old ask for? After the euphoric experience of escaping the Nazis, life in Hungary started to lose its luster during the Soviet occupation. I was looking for new challenges, and with my father's help, I found my way out of Hungary. When I was 17, I became a student in London. In my studies, my primary interest was to gain a better understanding of the strange world into which I had been born. But I have to confess, I also harbored some fantasies of becoming an important philosopher. I believe that I had gained insights that set me apart from other people. So I guess a philosophy degree ain't bad if you can make billions of dollars, right? Okay, I believe that I had gained insights that set me apart from other people. Remember that. Remember that line. Living in London was a big letdown. I was without money, alone, and people were not interested in what I had to say. But I didn't abandon my philosophical ambitions even when circumstances forced me to make a living in more mundane pursuits. After completing my studies, I had a number of false starts. Finally, I ended up as an arbitrage trader in New York. But in my free time, I continued to work on my philosophy. That is how I came to write my first major essay, entitled The Burden of Consciousness. It was an attempt to model Popper's framework of open and closed societies. It linked organic society with a traditional mode of thinking, closed society with a dogmatic mode, and open society with a critical mode. What I could not properly resolve was the nature of the relationship between the mode of thinking and the actual state of affairs. That problem continued to preoccupy me, and that is how I came to develop the concept of reflexivity. Okay, this is the key. Reflexivity is how he makes money, a concept I shall explore in greater detail a little later. It so happened that the concept of reflexivity provided me with a new way of looking at financial markets, a better way than the prevailing theory. This gave me an edge. So everything we do here is we have to have an edge. I mean, honestly, I don't really care because I think it makes a lot of sense, this theory. I don't care where he gets his bankroll from. It works because everyone that worked under him applies this same theory. Druckenmiller, who's a very infamous investor, he did Palantir. Once Druckenmiller said, I like Palantir, I'm like, okay, we got Druckenmiller believing in Palantir. I believe in Palantir too. Not only because of the charts, because, yeah, he has an eye for picking out rare gems. You know, that's it. That's all there is to it. I think a lot of as you see, if we go back to psychology here, what are the things that most people look at? Investors, we now see, are prone to cognitive errors, reluctant to realize losses and overconfident in their ability, but fearful that other market participants know something they don't. So why fear people that know things? If the insider tells you to buy Palantir, I'm going to believe him. What's wrong with that? Do you think they're trying to fake me out and tell me to buy something I shouldn't buy? Maybe. Maybe not. Maybe they want me to think it's a fake out and I won't get into Palantir. Huh? So if we keep like double guessing ourselves, triple guessing ourselves over and over and over again, we're not going to make any money either. You're going to be the guy that just keeps being a doubtful Thomas. Okay? And we're getting into Easter, so definitely you should read the Bible again. There's a lot of things to understand here. So, back to this. Blah, blah, blah. Undoubtedly, the conceptual framework was useful to me personally, but it did not seem to be considered equally valuable by others. I had to accept their judgment. I didn't give up my philosophical interests, but I came to regard them as a personal predilection. I continue to be guided by my conceptual framework, both in my business and in my philanthropic activities, which came to assume an increasingly important role in my life. And each time I wrote a book, I faithfully recited my arguments. So this is him just masturbating himself. Yeah. So whatever. I mean, I'm not gonna give a shit. Anyway, yeah, he gave a lecture called "A Failed Philosopher Tries Again." So let's get back to the crux of the matter. Let's see if we're gonna talk about reflexivity. Okay. Blah 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 blah. Oh, he talks about the brain too. Very good. Okay, very good, very good. Okay, yeah, I might have to continue this later. There's a lot of good arguments here. I can state the core idea in two relatively simple propositions. One is that in situations that have thinking participants, the participants' view of the world is always partial and distorted. That is the principle of fallibility. The other is that these distorted views can influence the situation to which they relate because false views lead to inappropriate actions. That is the principle of reflexivity. For instance, treating drug addicts as criminals creates criminal behavior. It misconstrues the problem and interferes with the proper treatment of addicts. As another example, declaring that government is bad tends to make for bad government. So you can see where all his Popperish ideas come out. So Popper really got him to think like this. So this is where you get him funding a lot of social justice stuff. And that's what it is. I don't care about that. I just care about his concepts of trading. How do you trade? Both fallibility and reflexivity are sheer common sense. But so when my critics say that I am merely stating the obvious, they are right, but only up to a point. What makes my propositions interesting is that their significance has not been generally appreciated. The concept of reflexivity in particular has been studiously avoided and even denied by economic theory. So my conceptual framework deserves to be taken seriously, not because it constitutes a new discovery, but because something as commonsensical as reflexivity has been so studiously ignored. Recognizing reflexivity has been sacrificed to the vain pursuit of certainty in human affairs, most notably in economics, and yet uncertainty is the key feature of human affairs. Economic theory is built on the concept of equilibrium, and that concept is in direct contradiction with the concept of reflexivity. As I shall show in the next lecture, the two concepts yield two entirely different interpretations of financial markets. Okay, I think that's a good way to end it. I will now just summarize this with an image I showed with reflexivity very simply. Okay, let's see. Do I have this image? Oh, do I have this image? Let's see. Da, da, da. Just so many things. Okay, let me see. Is it this one? Nope. I don't know. I always use this damn image, but I can't find it right now. Oh my god. George. Oh, reflexivity. I probably saved it somewhere on the web too. So let me see if I can find it. Nope. I can't find it. Dawn milkshake, no. Oh, Jesus. There's thousands of folders I got now. Oh, my God. Anyhow, I don't know. There's too many goddamn folders. Oh, man. I need a producer, man. Holy shit. How the hell you even fucking find anything anymore? Every time I make a show, there's another folder, and then there's another folder off of that folder. It's like, what the fuck? You know, where did this go? Where did that go? Oh, okay. Come on. Nope. 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 Soros. I searched Soros. I didn't find shit. Reflexivity. I didn't find shit. Amazing. Wow. I think I need a meta tag for my things now. Oh my god, I need somebody should make meta tags of all my images. Oh, I don't got time for this. Okay, so let's see. Fidelity says my cash in a treadle, so I'm not trading in good faith. Oh, you got that error? How much money do you have? It's like, bruh. Like, how does that happen? It only happens if you don't have a lot of money. Holy shit. Like, you use money that doesn't exist to trade or something. So when you bought something, you bought it with money that didn't have. I mean, I don't even know how they allow you to buy something that where you don't have money to complete the trade, but they still let you do it or so. It's like, did you do a market order? Is that why you did a market order and they let that thing go through and then it ran out? So that's probably why it happened. You have to do like a limit order. Because let's say you bought like a share at $5 and then it went up to $6 and then you bought it, they let you buy it anyway, and then they say like, oh, not good faith. Yeah, that's probably what happened. Even though I got a grand, I don't know, you gotta talk to Fidelity then. You gotta call them up. I don't know what that means. So shit. Right now, they allow you to what's the new setting of the trading rules now from the set by the SEC. Like your money gets settled the next trading day. So if you traded the yesterday, your money should be settled today. Unless you did a day trade today, then your money isn't settled, and then you trade again, then Fidelity dings you for some reason. I don't know. They call that a round trip trade. Bruh. Yeah, I don't know. You gotta call Fidelity. You better call them up. The customer service is very quick for Fidelity, honestly. Because if you don't understand what's going on, you better ask them clearly, like, why is this happening? What exactly did I do wrong? Because it's like you got to make sure you avoid those type of hits. Because if you get too many of those hits, they'll shut down your account. Anyway, Soros reflexivity picture. God. Okay, I guess I gotta do this. I mean, I'm not gonna find the picture, and I'm not gonna go through my old streams and trying to find it. So I just said, okay, search reflexivity picture. Okay, how about this? Let's see if this is good. This is an uglier picture of the one I usually put out, but I think that's good enough. So you got stock prices versus earnings per share. Earnings per share is the fundamental price, right? If the stock market was an efficient machine, it would hug this earnings per share very closely. But as you can see, there are situations where the stock price goes way over the fundamental and then way under the fundamental. You could think of this like Micron, right? Micron is probably going up on like the future growth of RAM prices. So they think, oh, in 2030, RAM prices are going to be like 50% higher. So of course there's a lot of growth in Micron. So they're going to overpay for Micron, right? Up. And then once earnings hit and earnings is not as good as they hoped for, and then you have this Iran stuff, and then there's repricing. Now it's going underneath what the fundamentals are. So that's reflexivity. That's reflexivity right there. And yeah, that's about it, I think. What else? So let me see what this AI thinks. George Soros's theory of reflexivity posits that investors' biases and perceptions influence market fundamentals, which in turn change investor perceptions, creating a reinforcing feedback loop cycle that often leads to market disequilibrium. The feedback loop. Okay, blah blah blah. Okay, what else? Let me see. Market. So what about the efficient? Okay, I don't know how to spell shit. Let me see. Versus efficient market theory. Okay, let's see. So, reflexivity theory argues that investors' bias market prices actively shape fundamentals, creating feedback loops that lead to instability and booms and busts. Conversely, the efficient market hypothesis asserts that markets are rational and prices reflect all available information and they always tend towards equilibrium. So, you see, now there's like two different ways of looking at the market. So, who's right and who's wrong will determine how you will trade and do things. Just got the first strike. Yeah, you better call them, dude, because like if you don't understand why you got it, then you're gonna get it again, and that's a second strike, and then you're gonna get it again, a third strike. So if you're gonna be an active trader, you better figure this shit out immediately. So anyhow, yeah, that's it. We got an hour. I think you guys understand what's going on. Blah blah blah. Soon miners dips and trading is yeah, that's why it's practice. And it's a good time to practice now, because if you practice in a calm market, you don't really learn anything because it's too easy. It's like if you had it from April, guess what? It's just like buy the dip, it goes up, buy the dip, it goes up. What do you learn? You don't learn jack shit because everything is going up together. Once you get into a bear market situation, we are on the edge of a bear market, you learn more. You learn the truth. That's why so many rookies in 2020, right, during COVID, the Federal Reserve was printing out dollars hand and fist. The government itself, the Treasury Department, was giving out PPP loans. Everything was going up. You don't learn anything. And then once February 2021 happened, what happened? Everybody started crying, right? 2022, Ukraine, Russia. Everybody starts crying even harder because you don't understand that markets have phases. There's a gas phase, there's a plasma phase, there's a liquid phase, there's a solid phase. In certain situations, the market behaves a certain way. Right now, we are about to enter into a stagflationary environment. That means oil will go up, natural gas will go up, dollar will go up, yields go up, but the economy keeps going lower and lower and lower. And then what you're going to do then? Guess what? You're going to buy gold and silver. So it's gold and silver that's going to go up a lot. It's not going to be your tech companies, right? Oh, got scared, but it's only like a few percent. Compare to how WebL and AIBU compare to the semiconductors. So you saw like the NASDAQ going down. You have to compare it to something else. Everything is a relative test. You have to test it against something else. How come software isn't going down as much as semiconductors on Monday? How come software was going down a lot, but not semiconductors? And then now you're kind of like wondering, holy shit, semiconductors look like a top, but software looks like a bottom. So then I think from now on, you're going to see semiconductors underperform software. Whereas in the first quarter, it was the opposite. But it doesn't really matter when everything goes down together, right? When everything goes down together, they all go down, but some go down less than others. Once you see like, whoa, semiconductors are going down like more than the software is going less than the semiconductors. Then once the market finally hits a bottom and goes back up, I would assume that software will outperform semiconductors. So everybody that's hiding out in Micron, Sienna, Lumentum, SanDisk, they're going to get punished. And the people that were actually buying the dips in Oracle and all the other ones, which is bad fundamentally. Fundamentally, when you look at those software companies, they still look bad. But because it's so cheap, people are more and more willing to take a bite, right? So That's the psychology coming in. Yeah. Anyhow. All right. 1 hour. I think you know what to do. Boom. Easy peasy. You don't let your psychology control you, but you let the psychology of the idiots control them, and you'll make money. Don't follow the herd. Don't follow the sheeple. That's all this presentation was about. Okay, so that's the quick update. Don't follow the sheep. Listen to the logic of the game. You look at the charts, there's a logic to it, and you'll understand. All right, guys. Later.